good afternoon, good morning, good evening, wherever you are in the world. And thank you for tuning in to the Seatrade Maritime News webinar on the market and legal impacts of the COVID-19 pandemic. In just the few weeks since we decided to put together this webinar, the situation has changed dramatically. We are now seeing a recovery in China and the lifting of curbs, the original epicenter of the outbreak. But the pandemic has spread across the globe, and we have seen unprecedented lockdowns across Europe, Asia, and the Americas, and just last night, the whole of India. The global passenger airline industry has virtually ground to a halt, and huge numbers of people are working from home. Amidst all of this, the shipping industry continues to operate and keep crucial supply chains flowing across the globe. The COVID-19 outbreak affects many different aspects of the industry, as you will see from some of the headlines on the slide here, which come from Seatrade Maritime News over the last few weeks. We have chosen to focus on the market and legal aspects today, as it was clear from looking at our reader numbers, these were the areas that were of particular interest and concern. We are very lucky today to have two highly knowledgeable and excellent speakers who will be taking us through the fast-changing market outlook and the legal issues that result from those challenging conditions. I would now like to hand over to our first speaker, David Jordan, Regional Director, Asia for Maritime Strategies International. Thank you, David.
Many thanks, Marcus, and thank you very much to the team at Seatrade Maritime News for inviting me to speak today. Over the next 20 minutes or so, what I'm going to do is give a very high-level presentation on MSI's most recent thinking on the coronavirus impact on the three main markets. So the focus will be the dry bulk, container ship, and oil tanker markets. Now, given time constraints, I can't really go into too much detail on each of these, but what I'll endeavor to do is cherry pick and highlight some of the main issues that are affecting each of them. Now, before we delve into the markets, I think it's worthwhile and necessary to set the scene a little bit. I mean, I know everybody listening in is fully up to speed with what's going on. But the main challenge for the markets at the moment, really from our perspective, is adapting to the speed and scale at which the situation is changing. Now, in order to stay ahead of the curve, the analysts here at MSI use our proprietary forecasting models. These are available through our online platform, MSI Horizon, and they use them to do scenario-based analysis for a range of possible scenarios, a range of possible outcomes. Now, for those of you who subscribe to MSI's regular reports on the various markets, we released our Q1 2020 editions, I think it was about 2 weeks ago. Now, the base case that formed the foundations of those reports are in the top line of this table that you can see on the screen, and that really reflected the reality of the time. So the core assumptions in that instance was that the disruption caused by the coronavirus would be China-centric, and it would probably unwind by mid-year. However, since then, over the last 2 weeks, events have escalated a lot more severely and more quickly than I think anybody would have anticipated. So as a result of this, we've updated our thinking with a series of scenarios that we actually just released at the start of this week. And these are detailed on the slides here. The interim base case, which is highlighted in red on your screens, is grounded in what we believe to be the current reality of the global disruption caused by the coronavirus. So in this scenario, the impact is largely felt in the first half of the year, but it will limit GDP growth for full year 2020 to around minus 0.5% to 0.5%. We'll then expect quite a strong rebound in 2021. Now, we also have scenarios for more severe disruptions, but again, given the time constraints, the focus of this presentation will predominantly be that interim base case. So, kicking things off with the markets, let's have a look at the bulk carriers. Now, before examining the specifics of the coronavirus's impact on the dry bulk market, it should be recognized that the fall in earnings that we saw in the market in the first few months of this year were by no means unusual. Typically, a handful of the same supply and demand factors combined in the first months of the year driving weaker earnings. These include weather disruptions at major exporters, weak import demand in China in the run-up to and over the Chinese New Year, and a typical surge in vessel deliveries in January. Now, prior to the global escalation of the outbreak over the last 2-3 week period, we were relatively optimistic about demand-side growth and dry bulk over the next 2 years. After the problems we experienced last year, most noticeably the Vale Dam disaster, we were anticipating a recovery in trade in 2020 and a relatively strong 2021. Now, beyond 2021, the outlook was admittedly weaker, with growth largely relying on the minor bulks. But, so that's where we were. So where are we now? Well, because of the outbreak and the way in which it's developed, the dry bulk market really rests on a knife edge between two possible outcomes. First, China continues to recover as industry elsewhere is disrupted. The supply of cargo remains largely unaffected. This drives down commodity prices and China imports a surplus. The second outcome is that the major commodity producers, places like Brazil, places like Australia, are also badly affected, and this starts to undermine demand in seaborne trade. Now, I mean, as we're all aware, things are changing, not just on a week-by-week basis or a day-by-day basis, but on an hour-by-hour basis. But I would say at present we are actually leaning towards the first scenario. But given the pace of change, there are some noticeable downside risks that we need to be aware of. So let's look at each of the major bulks in turn. So we'll look first at iron ore. As we all know, well-established fact, outlook for iron ore demand is heavily tied to Chinese consumption. Rewinding the clocks back to the GFC, in 2009, when iron ore demand was badly affected elsewhere and the price collapsed, what we saw was Chinese demand actually increased, and we're anticipating something similar this year. So what we envisage happening is that low global ore consumption elsewhere will drive down the commodity prices. It'll support stockpiling in China. And what we envisage is their preference will be for internationally sourced iron ore over their domestic alternative. Talking about downsides, the risks to the iron ore market is really, as I said, from the exporting countries. So, I mean, so far output from Australian and Brazilian mines have been generally unaffected by the coronavirus outbreak, but escalation in either country would severely affect bulk demand. Obviously, this would most significantly impact the larger size ranges, but it would trickle down eventually across the others. So moving on to coal, here China again, key source of import demand. The dynamic between supply and demand disruptions in China, is significant. Now, to understand or to appreciate what I'm about to say, you have to understand that China produces more than 90% of the coal it consumes. Therefore, a small reduction in production results in a disproportionately large increase in import demand requirements. Now, our understanding is that while coal demand has been impacted in China to date by factory closures, reports are suggesting that the impact on production has actually been even greater. So this points towards some underlying support for potentially increasing imports. One major importer that we're concerned about at the moment is India. So obviously they account for a large proportion of global seaborne imports. On the screen here we've got 259 million tons in 2019. But we're starting to see early indications that their imports have begun to fall. The announcement of the lockdown last night makes India definitely a market that we need to watch closely. But fingers crossed, if the virus is quickly contained, imports could well remain robust. And again, on the exporting side, the downside risks, there's very little impact to date. Indonesia cancelled imminent restrictions to limit coal exports to domestically flagged vessels. Very quickly on the grain trade, obviously food supply is vital for all nations facing this pandemic, and we expect governments will do everything in their power to support this trade. One possible issue here is the wider supply chain. The crops have to get from the farm to the port, and any disruption in internal logistic infrastructure will have a severe impact on exports. Very quickly, let's have a look at the supply side of the dry bulk market. One issue facing the market at the start of this year was the delivery profile of the order book. Now, I'm not talking about it being overly large. It was only around about 83 million tons at the start of the year, and this is about 10% of the existing fleet capacity. The issue was that it was very heavily front-loaded, with 70% scheduled to be delivered in 2020. One thing that the coronavirus has done is that it's obviously impacted Chinese yards. A lot of them closed down production. They're starting to come back online now. But Chinese yards have, increasingly sought to delay deliveries under force majeure clauses and, are probably likely to continue to do so. And what's this doing? This is effectively rebalancing the ordering book, particularly for the larger vessels. Now, yards elsewhere, Japan, Korea, in terms of remaining open, these have definitely fared better than their Chinese counterparts, but they are reliant on Chinese supplies, steel plates, etc. So any delay in steel deliveries will obviously have a follow-on impact in vessel deliveries in the midterm. Right, moving on to the container ship market. So when the coronavirus outbreak was limited to China, the disruption for the container ship market was largely in the form of reduced supply of containerized goods. Now, as the chart on the left-hand side illustrates, China's market share as an exporter on crude trades is absolutely substantial. The prolonged disruption to manufacturing and terminal operations that was caused by the initial outbreak was a severe disruptor of the market and the balances on these trades. Now, in recent weeks, we've obviously seen the epicenter for the outbreak shift from China and the broader Asian region to Europe and North America. And what we're seeing is that as Chinese manufacturing is coming gradually back online and the supply for containerized goods is recovering, it's now the demand for these goods that's being eroded. And this is likely to continue moving forward. If you take the Asia-Europe westbound trade as an example, so countries making up 50% of this head-haul trade have implemented quarantine measures, and at the moment this is only likely to increase. So while in the short term, as China comes back online, Asia-Europe listings may benefit from pent-up demand. As China comes back, there'll be renewed severe down pressure in Q2 as that fall in demand from Europe starts to feed through. So, given the disruption to Chinese output in Q1 and the anticipated recessions in key importing regions that we're heading into, it really shouldn't come as a surprise that we're forecasting that seaborne containerized trade is probably going to shrink in 2020. This will be the first time that the trade has fallen since 2009. Now, declines are likely across the four trade groupings that are detailed on this graph, so the main lane, non-main lane, east-west, north-south, and intra-regionals. The scale of declines are dependent on the quarantine measures that are implemented, and obviously this is very much a fluid situation. Now, if you were to ask us to put a number on this overall global decline of trade at the moment, we would probably go for around a year-on-year fall of around 4 to 5%. So not at the moment as severe in percentage terms as we saw in 2009, but still considerable. Now, one interesting aspect of the coronavirus on the container shipping industry has been the lack of impact it's had on container freight rates. By and large, they've remained stable as liner companies have resorted to what amounts to the most significant program of blank sailings in history. So estimates suggest that these amount to about or over 50% of all sailings on core routes. There's a couple of things worth noting on this point. First, spot rates are not very good indicators of the state of the container shipping industry. Roughly speaking, liner company revenues probably shrank somewhere in the region of about $2 billion in February. And the overall slowdown in the global economy represents a huge threat to their continued profitability. Second, the program of blank sailings is also creating significant issues around equipment repositioning, with further costs and this will incur further costs for liner companies down the line. Now, I will be speaking about time charter rate developments across the various markets a little later on. But there is one issue that I'd like to briefly touch on now, and that is the impact of idle tonnage in different size segments in the container ship market, and what this means for achievable time charter earnings. So this chart that we've got on screen now excludes the larger vessels idled due to blank sailings, which affect the overall idle fleet volume but have little impact on the TC rates. What it does is this graph demonstrates an inverse correlation between the two, between idle tonnage and time charter rates. We expect the count of idle vessels across size bands to trend upwards over Q2 as container demand weakens, and what this is essentially going to do is going to drive time charter earnings downwards. But as I said, I'll touch on that in more detail a little bit later on. But before that, let's explore the tanker market. Now, for the tanker market, the oil demand shock presented by the coronavirus are two very different things with the OPEC Plus cuts and without the OPEC Plus cuts. So before we explore, the coronavirus impact and the OPEC Plus cuts, let's walk briefly through the events the last couple of months just as a helpful recap. So after the robust markets that we saw at the end of last year, tanker spot rates fell off in late January. There was a combination of factors at play, but the main driver was this coronavirus demand-side shock that began at that point in China. So as the coronavirus outbreak spread across the world, it was assumed that OPEC Plus would implement compensatory production cuts. However, we all know what happened next. The negotiations earlier this month did not go well. Russia did not agree to the cuts. Saudi Arabia slashed prices, increased production or promised increased output in Q2. Oil prices plunged on the news, dropped below $30 a barrel. Bari then piled into the tanker chartering market, sending VLCC freight rates stratospheric. So that's where we are at the moment. They have started to come off, admittedly, and I think the latest fixtures done are around about $100,000 a day. But before delving into OPEC Plus response and the effect that it's had, let's start with the coronavirus demand side shock. And since that outbreak, and since the outbreak began in China, it is fitting that we start there. So the chart on this page details quarterly Chinese oil demand. We've put a little bit of history in there for you, but let's focus on the forecasts for 2020. If nothing else, this graph is actually very instructive in terms of understanding how rapidly the situation has been changing. The blue bars are the IEA's estimates from January. The yellow are based on our China-centric Q1 2020 base case that was published a week ago. And the green are actually our most current thinking. And there's a couple of salient features of this graph. First, the decline in oil demand in China in the first half of the year has obviously become increasingly severe. And second, given the nature of the coronavirus outbreak, this recovery that we're expecting in the second half of the year will not fully counteract the preceding losses in the first half. I mean, the ultimate impact of this slowdown in Chinese demand has been a significant impact on global demand. Sorry, this graph is historical and forecast global crude oil demand. And driven largely by these Chinese declines that I just touched on, global demand we expect in Q1 will fall by around about 3.4 million barrels per day on a year-on-year basis. Q2 expected to be characterized by further reductions in both OECD and non-OECD demand in countries, and that's on the back of, obviously the extreme containment measures that are taking place globally at the moment. If you look at 2020 as a whole, we're projecting annual global oil demand declines of around about 2.5% year on year, but obviously this figure does have substantial further potential downside. So, production. And obviously here our current outlook really revolves around the effects of the oil price war that's underway. So our underlying assumptions are that in Q2, Saudi Arabia will add around about 2 million barrels per day of production. Libyan production will return, and US output continues to grow at around about 1 million barrels per day, year on year. So I mean, just a quick side note, in our interim base case scenario, the detrimental effects of the lower oil price on US production only begin to be felt in Q2. So if you take this, fall in demand and this massive increase in supply, what does this mean? And effectively, what it means is that we're staring down the barrel of a massively oversupplied market. Probably somewhere in the region of about 5 to 10 million barrels per day. The repercussions of the surplus are difficult to overstate. I mean, obviously in shipping markets or in broader markets, it's encouraging stockpiling and the use of floating storage. One interesting stat that I picked up at the start of the week was that around 85 tankers are being used as floating storage at the moment, and they're storing an all-time high of over 131 million barrels of oil. However, it is worthwhile knowing that the scale of the surplus could actually exceed available storage capacity within months. And if crude cannot be stored and it cannot be processed, its intrinsic value will ultimately drop close to zero. And another quick side note, just very, very quickly, it's just a look at the development in the fuel price spread. Obviously something that was a lot of interest and continues to be of interest with IMO 2020. Essentially, the collapse in the oil price has narrowed the spread between VLSFO and HFO. So at the start of the year, the price spread was, I think, in excess of $300 per ton. We're now looking at levels of around about, $100 per ton on average. The differential in Singapore yesterday was actually as low as $29 per ton. Now, obviously, this comes with positive and negatives. For liners, it'll ease the burden on their balance sheets. However, for those owners who opted to install scrubbers, I think the new economic realities will be quite difficult. So, in an effort just to conclude and to draw together all of the various topics we covered in the presentation, I just wanted really to present our latest thinking on how our one-year TC rate forecasts, where they stand at the moment for 2020, how we see one-year TC rates developing this year. So what I have on this final slide are two graphs. The one on the left is for the historical one-year time charter rates for a small and a large bulk carrier, container ship, and tanker. The graph on the right details our current forecast and year-on-year percentage change in the rate for full year 2020. So the blue bars represent our forecast change from 3 weeks ago, our Q1 2020 base case, and the yellow bars represent our most current thinking. So just walking through the sectors in turn, we'll start with bulkers. Now, prior to the escalation of the outbreak, we thought that overall annual time charter rates in the bulk carrier market would be weaker in 2020 compared to last year. The positives of trade growth that I touched on a little bit earlier on, we were anticipating that these would be more than offset by potential fleet growth. Now, assuming that our interim base case holds, we expect the year-on-year fall in TC rates on an annualized basis to be more pronounced than previously in the larger size ranges. For the smaller size ranges, the scale of the fall is similar to our thinking at the start of the year. Now, in terms of, obviously these are annual averages, and in terms of progression throughout the year, we do expect to see improvements from about Q3 onwards. For container ships, as you'll see in the graph on the left, 2016 represents the bottom of the markets for the container ship, and this is very much a worst case scenario. In 2016, we saw earnings for numerous benchmarks fall beneath OPEX. Now, this year, we do expect earnings will fall, but not to the same extent as 2016. And again, there will be some recovery towards the back end of the year rather than a drawn-out trough in our interim base case. We think this is due to a mix of factors, mainly on the supply side, a more efficient cascade, and disruptions to the available fleet from delays at repair yards with the retrofitting of scrubbers. Finally, tanker. Now, if you came into this raw and looked at this graph, you would probably think the tanker markets are doing very well. And in the short term, you'd be absolutely right. The oil tanker markets absolutely appear to be one of the few beneficiaries of the outbreak. However, the longer-term future for trade is just as bad, if not worse than for other sectors, production must eventually adjust to demand. If this process is facilitated by a large reduction in US shale production, it'll reduce ton-mile demand on long-haul North American Asia routes. Further inventory drawdowns will be on a large scale and will further suppress trade volumes as refiners use stored crude rather than requiring further purchases. This will suppress import demand. Effectively, what the oil markets are doing now is borrowing from future demand. Given the scale of the current surplus, the longer-term loss of demand is likely just to be severe. So that's something to bear in mind. So that brings us to the end of my presentation and the market overview. So I will now hand over to Toby.
David, thanks very much, and good morning, good afternoon, and good evening to everybody that's joined us. Thank you, David, for your presentation. Thanks also to Seatrade for their invitation. I now want to look at some of the key legal issues for the shipping industry that have been affected by the COVID-19 outbreak. And in particular, I mean, we're seeing a huge number of queries across all of our sectors, but shipping by far the most concentrated of those. And they're largely looking at operational contractual issues. Force majeure and frustration, those questions in this time have been at the forefront, but also looking at whether ports are safe or not because of the outbreak, questions over deviation, quarantine of ships, and then some operational and regulatory considerations. So I want to talk through those. Like David said, I don't have so much time to deal with these in any great depth, but what we want to do is give you an overview so that you can at least understand the legal context. Obviously, every legal context comes from a particular situation. This situation is developing extremely rapidly, evolving all the time. So, of course, the advice changes depending on the particular circumstances. And if that's not enough of a lawyer's caveat, each shipping context, of course, will depend on its own specific facts and, most importantly here, the specific wording of any contract. And I want to look at that in a bit more in detail. So, looking at the shipping industry response, there are global measures being implemented by local authorities and, of course, individual ship owners all the time. There are crew restrictions, movement of people, movement of ships in ports around the world. As Marcus said, some of those restrictions actually are beginning to lift in certain places, which hopefully is good news for the areas of the world that are only really starting to feel the bite. Here in Asia, we've had that for some time now. But it is creating a huge impact. And in Singapore, where I am, the regulations are being updated daily, so we have to check with the ports. So what we've tried to do is divide the effects of COVID-19 on the shipping industry into primary effects, secondary effects, and tertiary effects. And for example, primary effects such as port and terminal or yard closures, the availability of cargo, for example, travel restrictions due to the quarantine of vessels or crew, global fall in demand, as David was looking at, and logistics and supply chain issues, which have come into sharp focus. Secondary effects, business interruption and delay, of course, and the knock-on effects of those in the contracts, what the contracts say. There are, of course, some potential benefits of shipping, such as the fall in oil prices. That will be good news to some people, as David mentioned. But mostly, these bring about some unpleasant issues that need to be dealt with. Termination of contracts. So was the termination lawful? Whether it constitutes a force majeure event, whether the contract is frustrated, and whether there are any insurance implications. Those would then moving into tertiary effects, which I think we can anticipate a bit further down the line. insolvency issues, either your own financial situation or counterparty risk. Can your counterparty pay in these circumstances? And again, looking forward for new contracts, making sure that those contracts are future-proof, they anticipate the specific circumstances that we are seeing now, they're suitable and have epidemic clauses, or they cater for your particular circumstances, and also helping clients with their business continuity plans and crisis management procedures, making sure that those are fit for purpose. But first of all, let's look at force majeure, because that is the hottest topic. What is force majeure? Well, a brief definition that I've got here, a force majeure clause is a means by which the parties to a contract allocate the risk of unforeseen events adversely affecting the ability of a party to perform its obligations under the contract. So let's break that down. It's a defense to non-performance of a contract. It's caused by an unforeseeable extraneous event outside of the party's control, and that's important. There isn't a legal definition, or a particular legal definition, of force majeure event, because a force majeure event is whatever your contract says it is. That's assuming you've got a force majeure clause. So if a force majeure event occurs, and the party relying on it complies with that clause, then the parties are excused from performance of the contract. In certain legal systems, France is a good example, a force majeure provision may be implied into a contract. So you need to pay attention to the governing law of the contract, particularly when set against the complex matrix of contracts for international supply of goods and services, and of course the charter of vessels. So under English law, though, a force majeure is purely contractual. It will not be implied into your contract. So if you don't have a force majeure clause, it doesn't mean anything. Using the phrase force majeure means nothing. For example, a provision in a recap that says the usual force majeure clause to apply was held to be void for uncertainty. You also want to be aware of back-to-back contracts. Are they really back-to-back? So looking at interrelated contracts, for example, the sales contract for the goods and the charter party to deliver those goods, often signed by the same party, looking at different aspects. In our experience, the charter parties tend to have less robust force majeure provisions because the standard forms have not been updated in the same way as the sales contract. Those get reviewed far more regularly. And again, the consequences depend very much on the precise wording of each force majeure provision, so they are often not back-to-back, and parties can be left holding the baby in circumstances where they wouldn't want to. So, can you rely on your force majeure provision? Well, unfortunately, it is all down to the precise wording of the clause, as I said, but this is really important. Generally, a party must show that it was prevented from performing the contract. Force majeure provision will not protect a party where there are alternative methods of performance, even if those are more expensive to perform. There are better words than prevented if you're seeking to rely on force majeure provision. For example, hindered. It's easier to demonstrate you are hindered, but again, rising price or additional costs would not be a hindrance. Delayed is another word, easier to invoke than prevented. Although again, a minimum period of delay may be specified in the contract, depends what it says. Otherwise, the circumstances of the particular trade or the circumstances prevailing at the time will depend on whether a delay is a force majeure event or not. So you need to think about how you can trigger, or what sort of situation will trigger your clause. Is it referred to expressly, which of course is far better, or is it a catch-all provision? But as I mentioned earlier, the situation must also be unforeseeable. There's an example of a Hong Kong case where SARS was not an unforeseeable event. So that correlates to the COVID-19, but of course it depends on the circumstances at the time the contract was made. What were the prevailing circumstances? And you've got to contrast that with the National People's Congress Standing Committee, which has already determined that COVID-19 to be an unforeseeable, unavoidable and insurmountable event. So if an event could have been foreseen by a party, it is much less likely to be able to rely on the force majeure clause unless that event is specifically referred to in the clause itself, because it could have taken steps to avoid or mitigate those consequences. The situation also needs to have caused the inability to perform. So it's got to meet what we call the but-for test. But for that situation, you could not have performed the contract. If you wouldn't have been able to perform the contract in any event, you can't claim that it is a force majeure event. That was a different circumstance. You also need to appreciate the implications of declaring force majeure. It should be done very carefully because it is rare for force majeure to bring a contract to an end. Consequences are generally to suspend or extend the time of performance of that contract. And if you make the wrong call, you could be in breach of the contract yourself. If your conduct amounts to a repudiatory breach of contract, it could entitle the other party to walk away and claim full damages for your failure to perform. So you need to evaluate each situation very carefully, nature of the performance, the time of the performance, and the period of any interruption to ensure that you've taken all reasonable steps to mitigate the event or its consequences before you can rely on it. Now, there are already standard charter party provisions dealing with contagious disease. Following the Ebola outbreak in 2014, BIMCO developed their infectious and contagious diseases clauses for voyage and time charter parties, which are for use in response to any virulent disease which were to take effect only in instances of extreme illnesses. These clauses provide that a vessel is not obliged to proceed to or continue or remain at any place which, in the reasonable judgment of the masters or the owners, where the risk of exposure to a highly infectious or contagious disease is seriously harmful to humans. So as fatalities increase in certain places around the world, there's a strong argument that this clause can be engaged. One thing that everyone should note, if they're not aware, BIMCO has made all COVID-19 related content on its website open and free for everyone, so for a period of 3 months. So it's very useful and good of them, showing how the community is coming together. But of course, one thing to mention, Ebola was relatively limited geographically compared to COVID-19. So we've been drafting a number of amendments and bespoke clauses which may be more appropriate to your particular contract or your circumstances. Some practical guidance. What should you look out for force majeure notices? Notice you're given if you believe a force majeure event has been triggered. You've got to read it carefully, pay attention to any time limits. If you fail to do so, you may have no defence to non-performance under the clause. Certainly as a matter of English law, the court or tribunal will interpret a force majeure clause very strictly and narrowly and against the person who tries to rely on it. It makes sense, of course, because one party is trying to exclude or limit their liability to the other. And so the burden of proof rests with that party who wants to be discharged from its contractual obligations. Force majeure clauses often don't provide the protection that the parties think it does, so be very careful. They've got to be absolutely clear that the events referred to in the clause prevent the performance of the contract. Non-performance is beyond the control of that party claiming force majeure, and that there are no reasonable steps available to avoid or mitigate the event or its consequences. It is not a magic bullet for all circumstances beyond the parties' control, and everyone should bear that in mind. Just a quick mention on shipbuilding contracts and force majeure. The BIMCO New Build Con form and the Shipbuilders Association of Japan form, two of the most commonly used forms in the shipbuilding industry, contain express force majeure provisions permitting shipyards to claim so-called permissible delay, postponing the delivery date under the contract if a named event occurs and is beyond their reasonable control. So if the delivery date is postponed by reason of permissible delay for a stated period, the ship owner may be entitled to cancel the contract. You need to look at those. China, of course, has made much of their governmental authorities issuing notices relating to COVID-19 in order to assist shipyards to evidence the effect of COVID-19 and claim force majeure under the contracts with ship owners. And if they can prove the existence of a named force majeure event, then they can expect to claim postponement. We're aware of several incidents of shipyards in China and elsewhere seeking to rely on those in response. But I won't say any more of that. I want to move on quickly to frustration, doctrine of frustration. There are similarities between force majeure and frustration, but frustration is not reliant on a specific clause in the contract. It operates at law. Where a contract is frustrated, it is immediately brought to an end by the parties, and the parties, are discharged of their obligations. For a charter to be frustrated, the delay or disruption would have to be so radical that performance is really, in effect, that of a different contract. So it's a very high test. And although the position may yet change, currently it's unlikely that the impact of COVID-19 would give rise to frustration, but that depends on your charter. And if successful, parties can recover amounts paid under the contract before it was frustrated, less the other party's expenses. So, when is frustration not available? Not available. So examples of that. Parties have made express provision for the consequences of a particular event has occurred. So, for example, if it is already in a force majeure provision, then it will not be a frustrating event because the parties have contemplated it and the agreement covers that situation. Similarly, where the alleged frustrating event should have been foreseen by the parties, then it is not frustration. So if it is obvious or should have been obvious, then it will not be frustration. Where the frustrating event or alleged event is due to the conduct of one of the parties, even their partial default, then it probably will not be a frustrating event. Like force majeure, if an alternative method of performance is possible, it is not frustration. Where the contract is merely more expensive or there are changes in economic conditions, then again, like force majeure, prices alone are not reasons to claim frustration. So, what are some examples? What are established grounds for pleading frustration? Well, unavailability, for example, of an essential person or asset, if they're unavailable, even for a temporary period, if that is a frustrating period. So it depends again on the circumstances of the contract, period of unavailability. If the method of performance is impossible, so for example, a contract for freight services where there's a travel ban in place, it won't be frustrated if performance is possible by a different method, but if it's all travel, then it probably would be a frustrating event. Failure of a specific source, for example, cargo, contract to import goods from a particular country which is subject to an export or movement ban, that would be a frustrating event, or illegality. So if performing the contract is actually made unlawful by a country, then that would be a frustrating event. When you're looking at charter parties, seizure of the ship during the Spanish Civil War. That's the good old case. Again, requisitioning and detention of a vessel. So there's quite a high bar to all of this. So you do need to look at that. Let's move on quickly to unsafe ports. Just a reminder that a port will not be safe unless in the relevant period of time the particular ship cannot reach it, use it and return from it without, in the absence of some abnormal occurrence, being exposed to danger which cannot be avoided by good navigation and seamanship, the good old test of the Eastern City. So safety very much, and all the case law looks at the physical characteristics and the threat they may pose to the vessel or cargo rather than the people. But the threat of a contagious disease can in principle render a port unsafe, so long as any risk to crew can be avoided by taking reasonable precautions. It would be unlikely that the epidemic would render a port legally unsafe. So if sensible precautions will prevent that, then it would not be an unsafe event. Of course, we've got pandemic status by the World Health Organization, but of course, this is now a feature of ports globally almost. Again, it is unlikely, but it's possible depending on the certain features of the port. Thinking about that, and deviation and quarantine of a ship. When can an owner refuse to proceed to a nominated port? And if an owner does deviate, what are those consequences? Well, if the port call would expose the vessel to a risk of detention or vessel being detained, blacklisted, etc., then the port may also be unsafe. General guidance is to be gained, and you should be very cautious in declining orders to proceed to a port, because refusal to proceed could constitute a repudiatory breach if the port is found to have subsequently been safe. And you must note that some charter party forms include express provisions to provide that the vessel is not to be ordered to a port where a fever or epidemics are prevalent, the Boltine form, for example. So, when can a ship deviate, and what are the consequences of calling it a particular place? Ship can deviate for the purpose of saving life. It excuses their owners from obligations to proceed with the utmost dispatch. However, the vessel could be off hire for the entire period, including repositioning. You need to check the wording. Voyage charter, there's the same liberty to deviate for the purpose of saving life, but no extra freight would be payable. There is limited to extreme situation where the crew member is seriously ill, for example, and you should be aware that insurance cover may be prejudiced, so you need to look at the position, even if it looks like a reasonable deviation at first. Under a time charter, there's an implied indemnity against loss suffered or liability incurred as a consequence of complying with the charterer's orders. So if the vessel is delayed at an at-risk port or being quarantined by reason of calling it an earlier risk port, any consequence or losses arguably recoverable under this implied indemnity. Under a voyage charter, laytime will not commence until a valid notice of readiness has been tendered. At common law, a ship may be ready without obtaining clearance from the health authorities or free pratique, provided that clearance is a formality. Some charters expressly provide that the vessel will be ready whether customs cleared or not, whether free pratique or not, but laytime will not commence where free pratique is or may be refused. Where laytime expires, of course, and the vessel is already on demurrage, in the absence of any clause providing relief, the principle of once on demurrage, always on demurrage will probably apply. And a very, very final word on operational and regulatory requirements. Thinking about statutory certification in particular, it's difficult or impossible at the moment to arrange for mandatory surveys and audits. So liaise with class organisations or others to request an extension before the due date of survey or the audit, and ensure that the certificates don't lapse. Again, crewing and maritime labour convention, the inability to repatriate seafarers in a timely manner, or them staying on board beyond the maximum period allowed. Contact flag state to request an extension, and have engage with them at an early time to be able to come up with a plan or get the required waivers. Port calls as well, ensure owners comply with crew requirements or additional port requirements. These are changing daily, so keep an eye on developments with the local port authorities, agents, or your P&I correspondents, etc. That is a very quick rattle through. I'm going to hand back to Chris for the Q&A session. Chris.
All right. Well, thank you, Toby, and thank you, Dave, for a great presentation. We're now going to move on to the question and answer portion of our event. As a reminder, to participate in our Q&A session, just type your question into the text box located to the right of the presentation window, or click on the Q&A icon at the bottom of your screen. And if we're unable to get to your individual question today, someone will get back to you after the program is over. We're going to move on now with some questions. Our first question is for David. David, can you talk to us a little bit about this? How does the current market outlook compare to that we saw with the global financial crisis in, say, 2008 and 9? And then specifically for dry bulk shipping in 2016?
Good question. I think it's good benchmarks. I think it'd probably be advisable if I divide my answer into two parts. I think first I should deal with the wider economy, and then after that perhaps the shipping markets. So with the wider economy, our current thinking is that, there's a lot of unknowns at the moment, and the situation still very much is developing. But our current thinking is that I think ultimately the impact of the coronavirus on individual countries' economies, the global economy, is likely to be as bad, if not as worse, in 2009 during the GFC. Moreover, the impact will be firmly centered on the real economy, rather than any financial markets. On the flip side, we also think that there's going to be greater scope for policy response. So I don't think anybody would deny that this is an unprecedented black swan event resulting from external forces. So governments are going to have a lot of latitude, a lot of freedom to implement stimulus packages, and I think is it $2 trillion that the US government's currently got under advisement. So ultimately we think that the ability to snap back could be a lot quicker than, say, in 2008, 2009. And I mean, this snapback argument is also supported by the fact that the banks in most OECD economies, are in a much better position than they were in 2009. So taking that and translating it into the shipping markets, in terms of demand, I think, yes, the impact in the short term could be as severe as in 2009. I mean, if you think back to my slide on container ship trade, we're currently looking at a fall of around about 4 to 5% compared to 9% during the GFC. But as I said, there's a potential for more rapid snapback. The other side of the equation, other than demand, is obviously supply. And when you compare where we are now to where we were in 2009, that side of the equation is a lot more balanced now. We're in a far better place than we were in 2009. I think the global order book as a whole is probably around about 8 to 9% of the world fleet. So there's not a particularly huge amount of overcapacity in shipbuilding. So the supply side should also be much better positioned to recover a lot quicker. Moving on to your specific question about dry bulk shipping in 2016. the depressed rates that we saw in 2016 were largely the result of, two main factors. I think the primary one was tonnage oversupply, and then there was also a slowdown in the Chinese economy activity. Now, taking the slowdown in economic activity, obviously we are seeing that, but, I think my previous point holds true that there could be this rapid snapback. In fact, we are seeing improvements in the Chinese economy at the moment. And again, referencing my earlier point about, being much better positioned in terms of the supply of tonnage. So, as I said, it's a developing situation, but, it's a developing situation that we do have to watch out for.
All right, thank you, Dave. I've got a question here for Toby now. From a legal standpoint, have you seen force majeure clauses being successfully implemented or applied?
The short answer is yes, we have, but at this time, no force majeure clauses which have been dealing with the new COVID-19 have been before the courts, so we don't know how they're going to be tested. That said, we're advising a lot on force majeure clauses in relation to the COVID-19 outbreak, and our advice has differed depending on the wording and the circumstances of the specific event. So to give you an example, where ports in a particular country were closed as a result of a governmental decree, such that a vessel was unable to load, the particular terms of that force majeure clause we said was triggered. But in other circumstances, we've taken the view that the force majeure clause was not triggered because it was insufficiently clear. So we said no, it would not apply. So again, going back to what I said previously, ultimately this depends on the precise terms of the clause and the precise terms, maybe the circumstances of a particular port or country that are applying at the time. So it varies, but yes, certainly some force majeure clause have been, we believe, successfully applied.
All right, thank you, Toby. Looks like we have time for one or two more questions here. Are we going to get to a next question here for David, or Dave? Dave, are there any scenarios in which container ship freight rates would start to drop considerably?
Yeah, I think, trying to be brief, I think the short answer is that the chances of a sharp correction in freight rates are now higher than they were. I mean, what will happen with freight rates will depend on a couple of factors. So first, we've got to look at whether liner companies will continue to lean on the program of aggressive blank sailings to remove capacity that we've seen so far, and whether they can maintain this discipline across the various alliances. Second, there's a question of whether individual liners will refrain from dropping rates in order to have a grab at market share. Now, the situation's slightly different now, because when China was essentially shut down, there wasn't really much point in dropping rates, given the lack of production, meant that sort of lowering freight rates wouldn't attract any marginal cargoes. But now that the production is potentially there, there could be that temptation again. And the final point I'd probably make is, it depends on how far demand is going to fall. And then, there's also the consideration of what's going on with the bunker prices. So I think ultimately our position is that liners are probably likely, given their current financial position, to do what they can to shore up freight rates. And that's probably going to, imply renewed disruption to sailing schedules and available capacity. But as I said at the start, the chance of this sharp correction is higher than it was, say, 2, 3, 4 weeks ago.
All right, thank you, Dave. A question here for Toby. Toby, could we see ships becoming unable to sail because they cannot make crew changes or complete statutory survey requirements?
Chris, yes, absolutely. We're dealing with lots of those issues at the moment. For example, Singapore has recently put a stop to all crew transfers. So there are significant issues that are coming up regarding repatriation. Seafarers staying on board beyond their maximum allowed period. As I said before, I think try and anticipate these, consider these issues early, engage with the authorities before the issues arise. Keep an eye on the port regulations to see whether crew changes and other elements can be dealt with. In terms of statutory survey requirements, I'm going to be hopeful that class and flag requirements are going to be relaxed at this time, and certainly waivers or extensions will be granted. But please, everyone, engage with those authorities early before the certificates expire.